Okay, it's 12:32 now. I think we'll get started. There's a bit of housekeeping first. I'm just about to put something into the chat, and I'll read it out as well. This is just a disclaimer, so everyone's clear on what this event is and what it isn't. So you won't find any personal advice in this during this workshop. The information should be taken as general investment discussion. If you need personal financial advice, you should seek this from a qualified independent financial advisor. We're not tax specialists, although at Source Capital you can invest with your ISA, SIPP or SAS. It's also important to keep in mind that past performance is not a reliable indicator of future results, and we will be talking about some past performance. So I think I'll share my video at that point. So hello everyone, I'm Stephen Wallace. It may have said that the host is John Wilson. It's not, it's me, Stephen Wallace. I'm the Operations Director at Source Capital. And I'm really happy that we've got everyone who's attending today. This is great, and we've also got some really good guests. I'll explain a bit more about their background and why we've got them on in a little while. But before that, I'd just like to share my screen to provide a bit of context to what we're going to be talking about. Okay, so just also to say this is going to be as interactive as we can be with these roundtables. So Q&A and chat is open. Please feel free to put questions or comments into there. And actually, first of all, if you can just, if a few people can just tell me that they can see my screen and see this this Word document with a BBC headline. Okay, yeah, great. Okay, the chat's working as well. That's good. Thanks very much. Okay, so it's 2020. So the topic of this roundtable is how to generate income from your investments in 2020. So obviously it'd be a bit foolish not to put a bit of context to that. We all know what's been going on and what's happened this year, but I think it can be we can lose track of all the time frames and when things have happened. So I just put a few things together which just explains the time frame. So although things were starting before this 31st of January 2020, there's a lot of news coming out of China, especially, but this is when I suppose it started to really get onto people's radars here. So 2 cases were confirmed in the UK from the same family, tested positive for coronavirus. So and this was the Chief Medical Officer for England who announced it, and it's the 31st of January. So this discussion is going to largely center around investments. We're not going to be talking too much about the health side of it, although obviously we know that is the context. So the first thing I thought I'd do is tell you what the FTSE was sitting at. So the FTSE 100, not the 250. And at that point, you can hopefully just see here, it was at 7,286 on that 31st of January. Just to go back a bit further, so it was around, what was it, 7,542 at the end of last year on the 31st of December. So it dropped a bit in that first month, but obviously we're about to see what really happened on the chart here. So by the 19th of March, so we're talking, what's that, about 7 weeks later, it's sitting at 5,151. So that was a 29% drop in less than 2 months. For anyone who had an index tracker, it would have been horrendous for people who owned individual shares. Likewise, probably for a lot of people. And it was at that point which the Bank of England voted to cut the base rate even further. So the base rate had been at 0.25%, and the Monetary Policy Committee on the 19th of March said we need to cut it further to 0.1%. We're not going to be doing things like predicting the future here, but obviously people probably have heard that there is the potential for negative rates. We don't know if that will happen, but it can't go much further before hitting that, obviously. Now, obviously, the FTSE was dropping, and that is a big problem for anyone who is trying to get capital appreciation and I suppose not speculating, but hoping that the share price goes up. But there is a bigger part of the problem. Remember, this discussion is about generating income from your investments. So I'm guessing some people can figure out what the bigger problem is, and it's that dividends got cut. That was the bigger problem for people who are taking a buy and hold approach and who are investing for the long term. They're not too fussed about price movements, especially in the short term. What they want to know is that they're going to be generating income and receiving those dividends. And basically this year, dividends got hammered. So this article is taken from the 19th of May. And for income investors, as I say, the biggest problem is that companies are slashing the dividends. Cuts and deferrals amount to £30 billion by that point. That's according to that article. According to the Financial Times, UK companies have cut dividends by 57% since COVID. And I'm going to link this back to something that people may have seen around lunchtime. Sorry, we are lunchtime, but earlier this morning, about a big company who have been a pretty good dividend payer. And I'm pretty sure they're not going to be any more. I'll wait till a bit later to share that one. So we keep going. So I think for a lot of us who are homeschooling, it was a juggle, it was a challenge. For people who are in lockdown, obviously it was a challenge as well for various reasons. And the summer did bring a bit of hope. I think if anyone took advantage of Eat Out to help out, it did lift everyone's spirits a bit. But the income options for investors just didn't get any brighter, and they haven't. So these types of articles are coming out regularly. This is one from a few days ago. It was the 21st of September. If anyone knows what the NS&I is, it's a sort of government-backed investment organization where you can, well, 25 million customers are looking to get a 1% return. It's going to be cut in the very near future to 0.15%. And it went from a best buy, and it's going to go down to 0.01 apparently as well. I think that's different types of those products. I've never invested in that myself. And this is linked to premium bonds, so that's how people might know it better. Yeah, so 25 million customers. That was a surprise to me when I saw that so many people go down this route. But yeah, I think it's a lot of people, they do it for their kids or grandkids to hope that they might win one of those big prizes. But now the actual return and interest on this has just been cut again. Yeah, so this is something, I don't know if anyone watches the TV and actually watches the adverts these days, but Nationwide, who I quite like, they've sort of resisted the urge to become a bank. They have been advertising quite heavily this mutual reward bond on the TV. It pays 0.5% AER gross a year, fixed for 18 months, which isn't exactly inflation beating. And when I see this, I always think back to around 2008 when there was this ICICI bank, which I think was Indian, but it was under UK regulations, so it had the Financial Services Compensation Scheme behind it. And I remember locking in a 6% 1 year fixed term deposit back then. Those days are long gone. And the kicks in the teeth just keep on coming again. This was just this week about how the state pension age is getting pushed out. It's getting pushed out further and further and further. Yeah, and so if you're a bit younger at the moment, who knows? Again, I'm not going to get my crystal ball out. Who knows what age that's going to be when we're potentially looking to retire? Which I think just makes. This is why I think I said in some of the communications, it's a topic that's close to my heart. All of this, because I think that people should have options to earn income while they're working, and it shouldn't just be your pension. There should be multiple ways that you can do it, and it's just so much harder now than it used to be. And even pre-2020, I think it was getting harder. But what's happened this year has just really hammered it. Yeah, so that just the final point, and then I'll start to get onto more of the interactive side of this roundtable. But just today, I was shocked. I read it out to my wife that EasyJet announced early today they'll make their first annual loss in their history this year. I decided to go and check their dividend yields for the last few years. So for the last 5 years, they've been at 3.1 to 5.3%, which I believe is pretty good. But it's going to be very hard to keep that up when you've made an £800 million loss and you're operating at 25% capacity, and that's what you're expecting into next year. So yeah, a bit of context as to what's going on, just because, yeah, I think without that context, it's then hard for us to piece things together that we're going to be hearing today. So I'll stop my share because that will allow me to bring some people in. So yeah, so as I say, I'm going to try and make this as interactive as possible. So we've got some polls that you're free to join in. You don't have to, and also yeah, please feel free to put any questions or comments into the Q&A or the chat, and every so often I'll do my best to just check those, and hopefully we'll be able to answer some of your questions as well. So as you can see, hopefully here, so we have our attendees here. So we have Craig Phillips, Michael Primrose, and Andrew Singer. I'll just quickly introduce them. So I've got Michael here first on my piece of paper. So Michael is the founder of the Property Finance Collective. Some listeners may also know him from his popular Property Finance podcast. He's got multiple business interests with a heavy property leaning. Andrew Singer has been a keen amateur investor for over 30 years, initially starting with stocks and shares and also managed futures. During his working career, Andrew worked on development aid projects in poorer countries, specializing in projects that aim to build up business activity. More recently, some people who are in our sort of world, the source capital world, may know Andrew because he's written a book to help investors titled Investing in Property Development Loans, and that's available on Kindle for those who are interested. Craig Phillips is our other guest. He spent the majority of his career to date in the armed forces, including the type of high-profile roles that we're not allowed to talk about. He founded his property companies, CCEO and Apex Zipa, in 2018-2019, and I'll let Craig explain during this roundtable how well those are performing. So what I'd like to do first is, like I say, trying to make this interactive. So before I start to ask specific questions to our panelists, I'd like to do a quick poll. We've got 3 of these. The first one is to find out what people invest in, basically. So I've got a big interest in various areas of alternative investments where I think it's relevant. I'll bring some of those stories into this, but it'd be good for us to know what everyone else invests in. So we're going to see if the tech works. I'm going to launch this poll. Hopefully everyone has the opportunity to vote on this. With this one, you can tick multiple things. With some of the others, it'll only be one opportunity to tick. So yeah, I'm going to give that just a chance to do its thing, and I can see it's working, which is great. So yeah, we had 10. I think there was a maximum of 10 that we could choose. So I tried to make it as broad as possible, but still relevant to what we're talking about today. So thanks everyone. It's great. People getting involved. Thank you very much. So hopefully that poll's come through. I'll give it just a little bit more. It seems like some people are still doing it. Okay, I think we're almost there. So what I can see, there's the two biggest, it's just moving a little bit still. So stocks and shares, a lot of people invested, I guess, in UK markets, and that might be through just through cash or through their SIP, maybe, if they've taken control of their pension. Direct property ownership is a big one. Business owners, great, lots of business owners here, and some peer-to-peer, quite a lot of peer-to-peer property lenders as well. Crowdfunding gets a pretty big amount as well. So does crypto. Yeah, I've got some interest in crypto. Might talk about that later. And bonds, ETFs, precious metals on the lower end. Okay, so yeah, really, really interesting. So what we're hoping is that this is going to be, I'll just end that. Okay, just bear with me. Make sure I do that correctly. Yeah, so what we're looking to do, so this is the first, hopefully, of many of these roundtables. We're going to do them every 2 weeks at the same time on Thursdays. And yeah, what we're going to look to do actually is go into detail about a few different areas of alternative investments. I think this one is a good starter because it's all about how to generate income. And to be honest, that's going to be, I suppose, a key theme with a lot of them. Some might be a bit more speculative than others. Some might have more of a capital appreciation income leaning. But for this one, we're going to talk about generating income. So, okay, so that's great. So let me what I'm going to do is go to our panelists. I just need to give people control so that I can get their videos on. So this particular question, I'm going to ask it to everyone. So Craig, Michael, and Andrew, and I'll go one by one so I can get your videos on where possible. But yeah, the question is, what investments do you have, and has your strategy changed during 2020? So let's start with Andrew. Let me just see, Andrew, if I make you, hopefully Andrew, you can now turn your video on and unmute. Brilliant. Great. There we go. It works.
Hello, everyone.
Hello. Yeah. Thanks, Andrew. So, yeah. So I think I'm guessing you completed that poll as well, but it'd be good for, I think, everyone to hear.
Oh, no. There was a big notice at the bottom of it saying it's not open to Roundtable members.
Ah, maybe that's even better then, so we can get your one-on-one information. Yeah. So the question was, what investments do you have, and has your strategy changed during 2020, Andrew?
Well, when a few years ago, I realized I needed to reduce my risk of my investments and make sure that I had enough income, because having been self-employed virtually all my life, to meet my income needs, I had to generate it from my investments. So I have various investments, but what they all have in common is that they're all backed by real property. Mm-hmm. So in my SIP, I invest in a fund, a Luxembourg-based fund, which is linked to LendInvest, which some of you will know about, which is an alternative lender, and a very successful alternative lender. And they have a fund which is a very attractive option. The other area that I invest in is stocks and shares, and I may want to talk a bit more about this later. But they're two particular companies which have a very good dividend record and are backed by real property. Mm-hmm. The first is Longbow, and that is a company which does short-term lending for large-scale property development, both commercial and residential, and so on. Mercifully, they don't have much exposure to retail. But interestingly for your listeners, that's available at a ridiculous discount at the moment to NAV. The NAV is 98p, and the share price when I last looked was about 72p. So it's an absurd discount, particularly for a company which is backed, because all of the loans that they do are backed by charges on real property. And they offer a steady 6% per year dividend.
Okay, and very interesting.
If you're buying at 70, 72 or whatever, the actual rate of return is spectacularly more than that, more like 8%. Really.
Okay, very interesting.
The other one is Warehouse, REIT. REIT, as you probably know, is a real estate investment trust. And what's interesting about Warehouse is that they, as the name suggests, they only invest in warehouses. And of course, they've done remarkably well through the COVID crisis, because e-commerce has zoomed up and a lot of big investors are getting interested in warehouse investment. And so the value of their investments has gone up. But interestingly as well, they also have a 6% dividend. Now, they are not available at a ridiculous discount at the moment, because the market has realized they're actually worth quite a lot of money. But even so, to have a 6% dividend, and by the way, over the last few years, they've averaged a 4% return in terms of share price movement. So those two are very good. And the third area that I'm in is property development loans. And at the moment, I'm investing with Sourced, our beloved hosts today. And that's an area that I really like, because, and I'll say more about that later if you want me to, but essentially, the returns are very good. Again, it's backed by charges on real property. And what I particularly like about Sourced is that they actually know all the borrowers that they deal with. And that's very unusual in the peer-to-peer area. So it radically reduces the risk for me of investing in individual loans. Right. That's probably enough from me. There's a lot more I can say.
That's great, Andrew. Yeah, we'll definitely come back to some of those things. So I know I put it in the chat for anyone who joined a bit later. It's great that we can get this sort of detail and level of, I suppose, exposure to what other people are doing. But please always remember, this is not personal advice for anyone. Past performance is not a reliable indicator of future results. If you need personal financial advice, you should seek it from an independent financial advisor. But at the same time, Andrew, it's great to actually hear the details of what you're doing. Yeah, and somebody just asked, can we write the chat of the company names? For those reasons, I probably won't. There will be a recording later. But for now, Andrew, thanks very much for that. I'll just now take back control. Perfect. And Craig, let's see. So Craig, if I make you the host. Brilliant. Craig, great. There we go. Got you as well. So Craig, so I think you know, we've obviously spoken a fair few times about different investments. I think maybe certain things have changed for you this year, but the constant maybe is your business ownership and your investment into your own business.
Yeah, basically. So just going right from the top is we've got a property investment company, but we're dual hatted because obviously during times like we've experienced recently, it can be important to pivot, maybe put some more emphasis on one element of the business and less on others. So we are currently developers. So we're developing a number of new build barn conversions and things like as in developers do. And a few flips as well, where you buy it, do a small refurb and sell it for a higher profit. And then on the other side is we've got a buy and hold element as well. So we initially started buying single lets and just renting them out to professional families and things. That's our current tenant type. And then what we've experienced with regards to some property specific rules, which is section 24, which I can go into in great detail another time, because I'm aware that not everybody's a property person, right? Although they should be, is that the part-time landlords prior to George Osborne and his bombshell a few years ago are now looking to offload these because they're no longer tax efficient. So we're finding great success in helping those landlords offload portfolios quite quickly. Actually, today we're just completing on a portfolio in Harrogate, central Harrogate, where we're buying 18 units all at once. Just because obviously it's great for us because we're able to build like a time machine where we can buy multiple units, but also we've structured it in a tax efficient way where we actually buy the company off a gentleman rather than the actual units itself, and it saves us a load of stamp duty and lots of tax and things. So there's strategic ways in which we do that, and that will just sit in our company and we will just get the rental income from that. And we're currently in negotiations for, I think it's another 68 units or something, which we will buy and hold. So during times like for us, because there is cash flow and cash is king and the cash flow is coming through the business, and we are focusing less on the new build and the conversion element, just because we're not 100% sure on what's happening next year. The stamp duty break that we've had in property specific into March next year has been great because we've been able to do a lot of off-plan sales. So the lumpy money is coming in through that, but we were going to reinvest the lumpy money into building the business and actually building cash flow and assets. So that's what we're doing property wise. And everything basically I earn, I just reinvest back into the company again, because we've got a long-term goal of where we want that company to be in 7 years' time.
Perfect, Craig. That's great. And I think, yeah, nicely tying in. I mean, yeah, I really want to keep that theme today, how to generate income from the investments. And like you say, these are income generating assets from day one, as soon as the portfolio is acquired in those examples. Yeah, brilliant. All right, thanks a lot, Craig. So I'll just get back the magic button and then ask the same of Michael. So Michael, I think you said you might have been out and about. Ah, you're not yet. There we go. You're in your office. There we go. That's
not out and about just yet. I might be out shortly, but
okay.
I'm still here at the minute. So mine's a lot simpler than Andrew's and Craig's to a certain degree, in that one of my main investments is probably Craig. So I'll just have it fairly simply. So I invested in his company earlier this year, the Apex vision. But more so, I mean, every penny operating business, which at the minute is the commercial finance brokerage, We focus on development finance, bridging finance. So it's sort of hand in actually getting involved with Apex, because we were doing pretty much all of Craig's finance up until that point. So I think he wanted to take the opportunity to take me on as a business partner to save broker fees, I think. Although I still charge him. But so yeah, all of our investments are all of mine purely back into my own operating company. And all of the property stuff we now pretty much just piggyback off of Apex. And sort of the vision is to just keep growing with those guys. So in terms of personal property stuff, there's not too much going on at the minute, other than a couple of commercial investments in the hopes of sort of expanding into those for the business. But yeah, in terms of my investment, every penny pretty much just goes back into the day-to-day operating of the brokerage, which every day seems to cost more and more.
Brilliant. Thanks,
so
Michael.
just ploughing everything back into there. I don't really make any other investments outside of that.
Brilliant. Thanks, Michael. And I think, yeah, there's obviously just reclaim back there. So obviously, I think the key theme there is that people are realizing that it is a time to back yourself, I suppose, to put money back into things that are within your control. I know, Andrew, you obviously invest in things which are external, but it is still within your control. You're still making those decisions, and not there might be some wealth managers on here, so I'm not going to speak ill of them, but obviously you do let go of the control when you go down that route. Yeah, okay, so what I'm going to do actually is we've got a second question first, actually, before we get into the next poll. So right, so Andrew, I think I'll direct this one at you. So again, if you just allow me to just make you the host again. Yeah, so Andrew, I've got a question directly for you here, and it's, what are the top 3 things you look for in an investment and why?
Well, you won't be surprised about the answers. I mean, essentially, the first one is security. And right now, what that means is property backed by real property. And the second thing is rate of return, because, as I say, I need income, and this is what this roundtable is all about. So that's the second one. And I think the third one is the loan to valuation, LTV, particularly because right now we're of what I believe to be increasing volatility and increasing uncertainty in the property market. And there's more I could say about that. Many of you will know about the important white paper called Planning for the Future, which will radically change the planning situation and probably radically reduce the premium on land for having planning permission. So there's all these uncertainties around. So I'm actually getting more nervous about the loan to valuations. In the past, I was going for 70%. In the future, I'll be looking for 65, no more than 65%. If anyone doesn't know what that is, I suggest you look it up on Google and you'll have a sense of what I'm talking about. Brilliant.
Okay, thanks a lot, Andrew. I think actually, Craig, I'm going to put this one over to you as well, because, sorry, I just have to always do this little bit of jiggery. So Craig, I'm going to bring this one back over to you as well. So Craig, I'm thinking about the same, because I know that you've looked into a few other investments as well, but I suppose this one's probably quite relevant for you as well. So what things do you look for in an investment and why? And maybe even a property investment, what are the key things you look for when you're appraising at one of these portfolios, maybe?
Yeah, it's everything we approach with regards to investing is our exit strategy. It's how are we going to get out of this? Because if we're going to be using our own funds or investors' funds, it's in 6, 12, 18, 3 years time, whatever, is how are we going to get out of it? So that's our primary focus. And we always have at least 2 exit strategies. So may I take, are we going to buy it? Are we going to keep it? Are we going to refinance it? Are we going to sell it? So that's my number one. And then it's a matter of It's, as Andrew said, it's the security element of it. So how secure? We tend to invest in an area just outside like Harrogate, York, Wetherby. There's a little golden triangle of good, I wouldn't say recession proof, but it's very solid market for sales. And so even if there was a dip or a recession and we had to offload to value, as Andrew said, if we're talking 65%, 75%, even if there's a dip by 5-10%, we're not going to get burnt too badly. So we're always kind of planning for the future in that way, planning for the worst case, hoping for the best, obviously. And then it's just a matter of envisaging that what do we try and make it structured towards what would we want to buy. So it's all right saying I'll do some of these horrible grotty little ones or whatever and I'll do them en masse, but it's like, well, is that going to cause you more problems? So we'd like to think, how hands off can we be on our investments, somebody else? And obviously the lower down the scale your investments, the more problems, the more management fees you'll incur, and that kind of, so is it actually cost effective rather than going up maybe a step and kind of, yes, you're not making as much money, but you're potentially creating less problems. And I think that's what we're all here for. We want to make money from our investments and we want to kind of get them hands off as much as possible. We don't want to be running around like the proverbial stressing and giving, basically investing. Sometimes if you don't do it right, you've actually given yourself a second job. And if you're working as well at the same time, you've now got a job on top of a job and a lot of stress. And where's the fun in that? So that's how we kind of, that's how we tackle it, or at least approach it.
Great answer, Craig. Thanks for that. Okay, so what I'm going to do now is I'm aware of trying to get everyone involved again. So I'll reclaim the host, and we've got our second poll. So right, let's see if I can make this work. Here we go. So the second one is maybe a bit easier. So it's just to understand how people invest. So again, feel free to join in. You don't have to. So we've got options here. It's going to be cash, ISA, or pension. And if I click the button, hopefully that's now started and everyone can see it. Obviously, there's the opportunity here to tick multiple if you're being super tax efficient. Still a few more coming in. I'll just give that a few more minutes. It looks like cash is the main one, ISA close behind, and people who I guess taking control of their pension, maybe with a SIP or a SAS. The smart cookies, really smart cookies who are super tax efficient. Okay, right, yeah, that's great. Thanks very much, everyone, again. Right, I'm just gonna do the quick bit I need to do with that as well. Okay, so, and then if I put that down there. Okay, great. So, yeah, I won't put you guys on the spot about that, but actually, Andrew, something's come in here, a question from the chat. There are various property investment companies who do not offer a charge, but rather ownership in a limited company that buys the asset. I believe that would be the crowdfunding angle, I believe, which is where I came unstuck, actually not understanding the difference between the two a few years ago. But actually, this probably leads a bit into, Andrew, as well, which was going to be my next question. So what's been your best income producing investment class in 2020 and what's been the worst? So again, if I can just give you, there we go, you should be able to unmute again.
I only got half of the second part of the question because it went copy.
Oh, okay. So what's been your best income producing investment class in 2020 and what's been the worst? And then maybe if you can answer that question that came in as well.
Yeah, first the question that came in, distinction between a charge registered at the land registry and a charge registered at Companies House. Now, the charge registered at the land registry, if the buyer defaults, if the borrower defaults, it's very simple to appoint a receiver. And then on which you have a first charge and get hopefully all or most of your money back. With a Companies House charge, I don't fully understand the process. All I know is it's not quite as easy and simple. So being a lazy sort of a chap, I stay with land registry charges. Second part of your question. The best have been sourced. That's the best return at the moment. The worst, I guess, has been because of the dramatic fall in the share price. But I don't expect that to last more than a year or so, because the NAV is what matters. If the company was broken up tomorrow, I'd get 98p per share. So the fact that people are only offering me 70p a share at the moment, I treat as ridiculous. Wonderful news for any of you out there who want to buy some shares, but I'm not going to recommend them, of course.
Brilliant. And so, Andrew, I know we mentioned actually, I think at the start in your sort of bio and intro that you used to, or you've been invested in stocks and shares and managed futures for a long time.
Yes.
So was there a certain time when you just decided that that wasn't the right strategy for you?
Yes, absolutely. When I decided to be semi-retired, I realized that not only did I need income, but also I needed more security. I didn't, you know, when I was investing in managed futures and stocks and shares this year, they can go down 30% all of a sudden, and you might need the money, you know, and that's a horrible feeling. So I realized that no, I'm not up for that anymore. Yes, I got some good returns and I had an exciting life, but now I opt for a less exciting life and decent returns, which will allow me to have a decent quality of life and sleep well at night.
Very good. Very good. Okay, I think haven't been to Michael for a while, so I'm just going to take back that host. Michael, come over to you. Yeah, Michael, I know we touched on a bit earlier about your company. Maybe you could tell everyone listening a bit more about how business has been going during 2020, and have you evolved or adapted to what's been going on, or has it, you know, been business as usual the whole year through?
So I would say pretty much from March through to probably June was business as usual. We didn't see a massive increase. We didn't see a massive decrease. So it was very much just plateaued during that time. But since June, we've seen a massive increase in business. And as such, about to employ additional people to load. So yeah, from my perspective, I mean, the market is very, very buoyant at the minute. It's very difficult because there's sort of 50, 60,000 brokers in the country. So there's only a couple of us. So it's very, very difficult to take one person's or one broker's view of the market, because we see such a finite amount of business that's actually out there that it's very, very difficult to say. But from our perspective, from what we've seen, definitely on the development side of things, so new build development, conversions, refurbs, it's just gone ridiculous. I think at the minute we're up to about 60 active cases. Wow. That are being funded, which for us as a small brokerage it's not too bad at all. 55 of those. So in terms of business, yeah, we've seen a real increase in that side. In terms of the term finance, I mean, we never really did term finance anyway, but we've seen a slight increase probably in the last 2 or 3 weeks in terms of HMO mortgages and also portfolio refinances as well. Again, people that are doing sort of similar stuff to Craig, we're buying up sort of portfolios all in one go and then refinancing them after sort of 6 to 12 months of ownership. But also where people have been developing and have realised, so have decided to refinance entire developments rather than putting them on the market to sell. So we've seen an increase in development exit products as well.
Yeah, brilliant. Yeah, that's
probably it really from me in terms of the market.
Yeah, that's great though. And actually this dev exit, it was the first time I'd heard that phrase yesterday. So I've only been with Source Capital for just over a month. Yeah, just over a month. I've obviously had an interest in property for a while, but yeah, that was new to me. But yeah, I can see the massive appeal of that type of product at the moment. Yeah. Great. All right, yeah, thanks a lot, Michael. Yeah, we've had something else on the chat here. I'll just take back control because we're going to do our final poll in a second. Yeah, a point here about crypto. So I'll try to be brief with my own crypto story. But in 2017, my friend showed me his phone and said, "Look at this thing called Ethereum. I invested at $8, and look where it's gone already." This was about May 17. So although I'd heard of Bitcoin, I thought it was all, you know, sort of criminals that used it. So I said, "Oh, that sounds quite interesting." Put a bit of money into Bitcoin and Ethereum. Sold Bitcoin on the highest it's ever been on whenever it was, December something in 2017. Ethereum I also sold out of, but I should have kept, I think, some of that. So I did quite well. I think, you know, some sort of silly return, not as good as other people, but something really quite good in about 8 months. I then dabbled a bit last year as well, did quite well on Tezos, if anyone's heard of that. However, you can't earn income from many of them. You can with some of the altcoins, but that is Wild West stuff. And it is a 24/7 market, guys. So the people in Asia are awake when we're asleep, and you might wake up and your portfolio has plummeted. So it might be for some people, but you've got to have a certain mentality, I think. Is it too late to get into crypto now? I have no idea. I left my crystal ball at home, sorry. Oh, actually, I am at home now. I can't say that anymore, can I? Anyway, right, so I've got a final poll, and then I might just ask another question or so. Final poll. So thanks everyone who's been joining in with these. This one is, what sort of annual returns are you typically achieving on your investments? There is an option for not currently investing as well. I know some people have mentioned, obviously, that they have and invest in their own businesses. So again, it might not be totally applicable, but if you think you can have an answer for this, then it'd be good to know what you think. I've just set that one going. Let's see if everyone. So with this one, everyone, you can only select one option. So maybe just what you think best reflects what you are currently achieving. It's always good to know. It also gives a bit of an insight into probably what types of investments you're investing in, maybe what your risk profile is a bit. Okay, this is really good. So the 9 to 13%, and actually it's about even between that 1 to 5 and up to the 9 to 13. Looks like 5 to 9 is going to win out. I thought that might be the case, especially if people are investing in a lot of peer-to-peer stuff. That tends to be a lot of the region you get there, and maybe a sort of diversified approach like Andrew's done will probably achieve something around there. Okay, that's great. Thanks everyone again. Yeah, so 5 to 8.99% came out on top, and then it was 1 to 4.99 and 9 to 12.99, which were next. And then there was 17% not currently investing. So to those people, thanks for joining us today. We really hope you're learning something. That's the aim. So let me just end that one as well. And has it allowed me? Yeah, I think it's allowed me to do that. So yeah, I think the aim here was that we were going to do about 45 minutes.
I think we may have actually lost Steve there. So Steve, if you can hear me, you've.
It did. It kicked me out. Have you got me back?
You're
Have
back.
you got me back? It let me finish the poll, and then it kicked me out. Right, I'm hoping we've still got everyone here. We have, good. It was only me. The poll didn't like me finishing the polls. Okay, so I wonder, Andrew, I know you were maybe looking to add something earlier. I think was that surrounding the income producing investments. If there was anything else you wanted to add on that, it would be greatly appreciated.
I think you touched on something quite important there, which is diversification. And there's a trade-off, you know, because your 10th investment or second investment. So how many different ones do you need? And for me, I like to see about 3 to 5 different investments in my portfolio. So I keep it tight and small, enough so that if one of them completely sunk,
yeah,
but, you know, it's a very interesting one and it's a question of judgment. You know, there's no pure maths on it. It's a judgment call. But for me, if I've got 3 to 5 good ones, all of which I'm happy with, even one, then
yeah, and I think I'm the same. I think there's certain phrases. I think you can never be too diversified. I think providing, I think Craig sort of mentioned it earlier, as long as you're not creating a job for yourself, then maybe you can never be too diversified. But I think at the same time, it's covering off different asset classes, isn't it? And I think that precious metals have obviously had a good time this year. But the only challenge with those is that they're not income producing unless you're going to be buying and selling and you're not actually physically taking them, and you may be looking at ETFs instead. Then you need to make sure the ETF actually holds that gold and isn't just linked to gold. So there are, yeah, you know, there's a lot of areas. This sort of alternative investment world is fascinating, really. But a physical asset that you can go and see, you know, that's the benefit of property, really, is you can turn up and look at it if you want to. Yeah, Craig. Yeah, 1 second.
That's right. I can do it myself, Steve.
So you can. It looks like it's just freed all that up. Brilliant.
Well, so a few years ago, I had a business mentor, and he always uses an analogy, and I still use it to this day. Is what you're only financially secure as the table. So he imagines a table with 3 or 4 or 5 legs under that table, and you're more secure. But if you've only got one leg, and I think a lot of people are finding this at the moment with regards to COVID, a lot of people are being laid off. There's going to be a lot of redundancies, and that's just on the horizon. And what a lot of people do is they live hand to mouth, paycheck to paycheck, and they've only got one leg under the table. And all of a sudden, I think where you're saying like diversifying, it doesn't have to be a massive thing. As long as you've got 3, 4, 5 types of income generating investments, and whether that be something, and I don't know anything about crypto, and I don't know anything about precious metals. And what I do is I know about my property stuff. But like I said, even in my intro, I mentioned the fact that we had different ways that we do it. We have buy to hold, we have lumpy money, and we can pivot within our company. And I think a lot of the people who are on this webinar at the minute, they need, if they're not doing already, which I'm sure they are, is they need myself another leg under my table just in case something gets knocked away. And if you've got 10 legs, like Andrew says, underneath his table, great. But what you don't want is you don't want one, and you don't want one that being your job, because if you're in a job, then you're completely at the behest of the company, and you are completely reliant upon somebody else dictating how you're going to live your life. And I think that's the scary thing. And that's something that I learned maybe 5 years ago, and I was like, I am not being in that situation again. So it's really important you do get your investments. They can be really low risk at the start, but as long as you start with time and maybe learning a little bit more, then it does give you that opportunity to give yourself, who knows what it's going to be like in 6 or 7 years.
Yeah.
And I don't want to hijack it, but you know me, Steve, I just talk forever anyway, right? So I'm the ideal panelist because I don't want to shut up. But if you would have said 10, 15 years ago that the high street was going to die and everybody would have been doing conversions, look at the high street now. I mean, the high street's dying in 10 years, and I'm not any crystal. Everybody's being given opportunities now for buying high street units, doing conversions into apartments. And I can personally, my opinion is in 7 to 8 years time, the high street's going to be dead. I mean, it's going to be a place where you all do your shopping online, and the high street's going to be full of cafes, bars, and social events. That's all it's going to be. Because, I mean, I've even got a daughter now who hadn't sent her to buy plant pots. She just buys them online and they get delivered to her door. I mean, that's just the way the generation shops. So you never know what's going to happen. So like I said, as long as you can pivot, and as long as you give yourself more opportunity to invest in other asset types, and like Andrew was saying, if you have six legs under your table, you have 6 assets, and if one stops performing, we'll ditch it and go and get another one, and just don't have one. That's the scary part.
Yeah, no, thanks, Craig. No, I couldn't agree more. We've had a couple of other questions in. I'm not sure if Andrew wants to take Voon's question here about view of gold. It hasn't been the hedge to equities like it used to be. Do you have to wait for inflation to creep back up again? Yeah, Voon, very, very good question. Andrew, are you happy taking that one on? I think, can you unmute? I think I'll do it.
I'm generating and gold doesn't generate any income. So, you know, I would go into gold, but I'd have to be really scared about everything else before I went into gold. You know, I treat it as an emergency type of investment when everything else is looking just too damn scary. We might get there, things are very uncertain at the moment. We might get there, and maybe in a future roundtable, what the prospects are over the next couple of years. But at the moment, no, not gold.
Okay, no, thanks for that. I'm aware that we did say it would run to 45 minutes. I know we've gone a bit over, but it looks like people haven't been dropping off. They're obviously enjoying the discussion. There was just one thing in the Q&A: why sourced capital as opposed to house crowd? That's a very good question. I feel like I don't want to answer it directly because I didn't have a great experience with that latter company and with a few others. I think I mentioned it earlier, though. It was my mistake. I didn't understand the difference between crowdfunding, where you are piggybacking on the developer's profit, versus peer-to-peer, where you are lending. So it's a loan, right? So if you have that loan with the first charge, you get paid back first. So certain experiences I've had with other companies that I like very much, and I think it's not always been their fault. There's been various reasons why things have been delayed and prolonged, but yeah, I've had some interesting experiences as an equity investor, which has put me off equity, where I don't have any say in what's going on. That's for sure. Okay, I think we are going to leave it there. Sorry, Michael, I know I haven't got you back in any point, but I'm not sure if you might have been traveling as well. Michael, you able to bring yourself off mute as well? Yeah, I don't know. Anything else to add? I know you sort of mentioned early on that your main interest is in your own business, and that you so I suppose you're an SME business investor directly, aren't you? So not through the stock exchange or anything. You like to get to know these companies.
Realistically, yeah, and that's it. And I think the important thing is, I mean, a lot of our stuff is for our own benefit. We're 100% in control. There's no outside influences to a certain degree. In the investing in the stock market, everything else, you don't have the same level of control. I mean, for me, my business, I can control how much business we do, how little business we do. To a certain degree, I can turn the marketing on and off whenever I want. And I think for me, that's where I prefer that investment as opposed to putting however much into. But I understand why people do invest in stock, shares, ISAs, everything else. But yeah, for me, investing in our own company, as well as obviously smaller development companies and smaller property investors and larger property developers like Craig, that was built over a number of years of relationships. So yeah, for me, it's all about putting ourselves first in that sense, investing in our own businesses first, and then using relationships that we've built over the last 4 years to use that as an in to invest in other people.
Brilliant. Yeah, thanks, Michael. I think that's probably a good place to finish on. Actually, it's all about the relationships, really. So yeah, I think we're going to finish up really quite soon. So thanks very much to Craig Phillips, Andrew Singer, Michael Primrose. All can be found on LinkedIn. I'm sure you won't be surprised to hear if you want to reach out to those guys and hear more about what they do. For the next one in a couple of weeks, like I say, I'm going to try and continue this alternative investment theme. It might not be this one next because we've got a few things competing, but if anyone is a novice or experienced trader or a crypto investor, I'd like to hear from you. It's stephen.wallace@sourced.co. Please get in touch or find me on LinkedIn. It'd be good to hear about how you're getting on. As I know, obviously, volatility is your friend if you're very good at what you do in that area, but it's a bit too Wild West for me still, I think. So thanks very much everybody for attending. For those who've caught this on the recording, thanks for signing up, and we'll hope to see you on the next one. Craig and Andrew, thanks very much again. Have a good day and speak to you all soon.
Thank you.
Thanks a lot.